What is liquidity? Specifically in Forex, we always hear it's the most liquid market in the world, but why is it so liquid and how does this liquidity affect traders? I see a lot of videos explaining what liquidity is in terms of how to trade it, which is great and is needed, but I want to try to take a stab at explaining what it is and how brokers use it so we can get a holistic understanding of how retail traders can use it too. To do this, I want to try to give my understanding of the following: why foreign currency exchange has and needs such high liquidity to function, how brokers create and use this liquidity to keep the markets functioning, and finally, how can retail traders also benefit from the creation and use of liquidity. First, let me give my definition of liquidity, because there could be a few depending on the context. Liquidity to me is the ability to easily facilitate a transaction. Now, usually this transaction is into cash, but in terms of the Forex market, it's all cash already, which is why I leave it at just a transaction. If you want to buy a house, there's a pretty lengthy process, not so liquid. Compared to, say, you want to buy a candy bar, you can easily walk into a store and do so. Pretty liquid. Now, I know that might be an out of the box example, but remember, in the Forex market, liquidity is all about being able to facilitate transactions. So, with that definition in mind, instead of explaining why Forex is the most liquid market, let me try to explain why it needs to be so liquid and why the ability to easily facilitate transactions is so important. Let's say Toyota, a Japanese company who does business in the USA, needs to pay US taxes on profit on cars sold in the US. They'll need to exchange Japanese yen to US dollars to pay these taxes. And as you can imagine, this would be a large sum of money, with Toyota being a Fortune 500 company and having over $250 billion in total revenue. If the US wants their taxes paid in US dollars, a market must exist to easily convert yen to dollars. But this is just one example. For a global economy to run, you need countries to have comparative advantages over each other, which refers to the ability of an economy to produce a given good or service in a more efficient and economical competitive manner than its peers. This leads to global trade, which leads to a huge amount of money needing to be exchanged to complete these trades. Again, this requires a highly liquid currency exchange market to exist. Great. Hopefully that takes care of why Forex is so liquid. Let's talk about your broker. In Forex, there are primarily two types of brokers: ECN and STP brokers, which stand for Electric Communication Network and Straight Through Processing, respectively. And then there are market maker brokers. ECN and STP brokers do have some slight differences, but for this explanation, we'll treat them the same. Now, let's say you have an ECN or STP broker and you place a trade. Your broker will pass that trade directly to what is called a liquidity provider, which is essentially a large institution such as banks or hedge funds that will take the opposite position of your trade. For example, if you're selling Euro USD, they are buying it. Now, ECN and STP brokers can't just send your small order alone to a liquidity provider to be filled. There are usually some pretty high minimum order requirements. So the broker will wait until they have enough of the same orders and then place that block of orders at once to the liquidity provider, which is why we commonly refer to this as an order block, or as I call them, decision blocks, which is a consolidation, then a large move. I call them decision blocks because it's at this point the majority of traders decided to go in a certain direction. Now, I won't go too much into this, but liquidity providers don't always keep the opposite of your position. They can match most orders to other orders, or they may keep some volume as risk if they have a market biased. Mostly outside of this, they will hedge big positions with other liquidity providers, make money off the spreads or commissions, and break even on the trades. It's all just money flowing around and around, and there's a lot of manipulation to do it. But this is how brokers are able to keep the market so liquid. Now, I know I skipped over market maker brokers, but they are very easy to explain. They are basically mini liquidity providers that retail traders can place orders with directly. They will take the opposite of your trades and then hedge their own positions with liquidity providers instead of passing your position to them. So now, knowing all this is great, but how can you benefit? Understanding that the goal of brokers and liquidity providers are just to continue facilitating transactions easily, we can understand why liquidity sweeps and stop hunts happen. Brokers and liquidity providers want orders so they can fill other orders. The more stop losses they can hit, the more flexibility they have to fill those orders. This helps them run their business smoother, which leads to more profit. So if you feel like they are going after your stop losses specifically, it's because they probably are, but it's not personal. You, along with thousands of other traders, have a pending order at that level, and the brokers want your business, so they move the markets to get themselves that business. Now, this all happens on such a massive scale, it's hard to really understand exactly what is happening. So remember, this is my own speculation, but let's look at a couple of quick examples on the chart to see what this could look like. The market is consolidating, brokers are waiting to place orders, finally enough trades are placed in one direction and an order block is created and price breaks out of the consolidation. Here are two possible outcomes that can come from this, and again, this is only my speculation. A, the only reason price moved so quickly from the decision block was due to brokers wanting to grab all the orders sitting above the consolidation, and once they do, they combine it with all the other sell orders they have, and price sharply moves back down to the consolidation zone and continues selling off into the intended direction. Or B, price moves slowly back down as liquidity providers hedge positions, more orders are filled, more liquidity is taken on lower levels, and price finally comes back down to the order block. Because this was previously a good value area to place buys, more orders get taken from this level for traders or big institutions, and price trends back upwards. This happens all the time in Forex markets on all levels, on all pairs. I could cherry pick 100 examples to show you, but it won't help. Go to your charts, find them yourselves, and get used to identifying them. Creating a plan with risk management, entry and exit rules, staying disciplined to your plan, and you might just become a profitable trader.